Hi, everybody. Welcome to my YouTube channel. My name is Rick Seachelog. I'm a senior loan officer with Edge Home Finance. We are the second largest mortgage broker in the country, and we're based here in Minnesota. And I was just going to tell you that when I was a young man, really young, I hoped that Santa would bring me these two Western figures for Christmas. And lo and behold, he did. Bingo, I got them. Hope is such a wonderful thing. Hope is the key ingredient for any motivation that we may have. So, what I'm hoping to do here is show you and give you some hope if you are wanting more money in your pocket every month, and most of us are, that we can actually do that. So, there's a lot of opinion out there in the world today, whether it's from the news or from your brother-in-law at the Christmas party. But the bottom line is, with knowledge will give you the faith to act for you and your family to know that you're headed in the right direction. So with that, we're going to quickly figure out I am not a professional videographer, but please bear with me and don't let that change the information that you're about to get. A little bit of looking in the past is simply this: have less savings now and more debt. Back in the beginning of 2018, our savings rate was between 5 and 10%, and it got all the way up to 10% back in January of 2019. Then it kind of held there, and this light blue line is the pandemic. I think we all remember that. And then all of a sudden, our savings rate shot up. Why? Stimulus money. We had extra money that weren't expecting. But that kind of dwindled down, and our savings kind of dwindled down. And here's the other two um, stimuluses that kind of shot up savings rate, but then it kind of went down, 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 down to right now. It's almost half of what it was back at its peak in January 2019. At the same time, our savings rate has gone down. Our credit card balances have gone up. As we are looking here, we were here at $760 billion. Now look at where we're at. We're almost twice that much because the same thing happened. When they were going up, 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 the pandemic hit, we got the stimulus, we paid it down, which is probably the smart thing to do. We dipped a little bit more into it when the other stimuluses came out, but then we said we really like this ability to spend, so we just kept spending and we put it on our credit cards. And then back here in the spring of 2022, your credit cards were at 14%. But what happens when the Fed starts raising interest rates? Not only do rates on mortgages go up, but they also go up on your credit cards. As a matter of fact, I have 22% in here, or actually MBS Highway has, and we want to thank them for all the charts. Barry Habib and his team do a great job of collecting all this data. And where 22% is probably pretty low for a credit card now. You probably could be paying 25 to 30%. We also know that right now that the average car payment is $800. That's doubled in the last 3 years. And 17% of all car payments now are over $1,000. And this kind of being understated by a 6-year term or by longer leases where you have to turn the car back in and basically get no equity at all out of it when you turn in the lease. At the same time that our credit card debt's going up and our savings are going down, the average loan to value of homes has also been changing. Back in 2008, 81% of what you owed it was the mortgage. Your mortgage was 81% of your whole house. Here's the value of your house. Here's what you owed, 81%. And then steadily gone down. So right now, 2002, because you've made your payments, your balance has gone down, and then your house has appreciated in value. So you have quite a bit of equity right now. In fact, the average equity in the United States is $231,000, and of that amount of money, you can take cash out of $185,000. You still have cash value of your home. You still have a higher value than what the loan is, but you can use $185,000 of that amount. So But Rick, I have a 3% mortgage. No way would I touch this. Granted, you have a 3% mortgage, but let's take a look at your blended rate calculator. If your mortgage is at 3% and you owe $343,000, but you have $20,000 on a Visa, that's going to be 24%. MasterCard 24% or higher. Discover 22% or higher. Macy's 21% or higher. Nordstrom's 22% or higher. Your actual blended rate, you owe $411,000. And that blended rate is 6.331%. You can say, but Rick, I'll have these paid off. Take a look at how long it takes to pay off a credit card. It's on your statement and it's there every month. This amount is a second mortgage where you're paying over 20% on everything, probably over 25%. So what do we do? Well, let's take a look at the sample here. We've got some, we qualified, these are numbers that there's not anybody's house. These are just numbers on average house. And we used Rosemont, Minnesota, because I graduated from Rosemont, so we're going to use Rosemont math on all this. That's the only math I know. But in 2018, you bought your house, June of 2018, for $330,000 in Rosemont. Nice town. Annual property tax is $3,861, and you're paying $170 a month for your homeowner's insurance. So what has happened since 2018, your house has skyrocketed. The value on it is now $261,782. Again, these are just calculations based off of the whole housing market. Did you refinance? Well, yeah, you weren't a fool. In 2021, with the low mortgage rates, you said, yeah, let's get on that. And you actually took a little bit of cash out because remember, you bought it for $330,000. Now all of a sudden you're going to take another loan out for $375,000. And you do that, and so you had a little bit of money to do with whatever you wanted to do. And you got 3.25% financing, which is really good. So right now, your remaining balance on this loan that you refinanced in 2021 is just shy of $360,000. And your house payment based off that is $1,632 for just principal and interest. We'll get into the escrows again. Now, how much do you owe everything else? Your current debts are your Visa card for $20,000, your Discover card for $10,000. So what we're saying is you have $30,000 of credit card debt. That's not uncommon in today's market. And then you have vehicle loan or loans. That total is $48,000. But here's your payments: $660 for the $20,000, $380 for the $10,000, and just over $1,000 for the vehicle loan. So you're paying $2,084 to service this debt. We're going to use a couple of different ratios. We want to make sure we leave you in good shape. So your front, this is actually the back end. Basically, you're paying 43% of your income to these, to all of your debt management. So what we're going to do is we're going to take this, we're going to say, we're going to keep the loan to value under that 80%. So you don't have to pay mortgage insurance. It's going to be a new loan. It's going to be 30 years. It's going to be conventional. It's going to be fixed, and our rate's going to be 6.987. So it's higher than what you're paying right now. You're not going to pay any points. There's not going to be any mortgage insurance because we're going to keep it under 80%, and your closing costs are going to be $3,000. You're going to have title work and things like that you're going to have to do. So if we can hit calculate it, here it is. So existing right now, your house is worth $561. No matter how we slice it, it's still worth, whatever you do, it's still worth $561. Right now, your loan balance is just under $360, and this is going to take it up to $440. So your equity is right now $202,000. Here it's only $124,000, but you still have equity in your home. Again, you're going to have to pay closing costs. Your estimated available equity is $202,000. Right now, after you do this, is going to be about $8,690. That's available at 80%. That's not, you see, you owe that. You have 124, you can only get another 8,600 out of it. So your rate's going to go from 325 to 6.957, and no mortgage insurance, and the debt balance, you have $78,000, and we're going to take that debt and we're going to put it on your mortgage. Your front ratios are very, very simple. With the existing, 29% of what you earn is going to go for all of your debt management in this example. And we stay under that 80% at 78%. So that's so you're not going to be paying any mortgage insurance. So right now the existing is you pay $632, and $492 insurance and taxes are going to stay consistent. You're paying $1,044 on your car payments, and you're paying $1,040 for your credit card. So you're paying out $4,208. Proposed, this is going to go up to $2,900. You're going to have the same $492. So your house payment and your only debt payment is $3,420. Here's where my Rosemont math comes in. That's $788 you're saving every month for your debt. $788 is going into your pocket. If you don't know what to do with it, if you want to see this really accelerate and really pay a big difference, take a look at this. If we take that $788 a month that you've got, remember you're already paying it. Now we're going to take that, we're just going to put it on the principal of your mortgage. If you do that, you are going to save a whole 11 years off of your mortgage. You're going to save 132 payments. So what does that mean? So right now you're existing, you've got $360,000 for your mortgage, and you got $78,000 on your debt. Over here you got the $440. So you're going to take that $788 and put it into your principal every month rather than just spending it on something else. After 5 years, because your car payments will probably go away, but your credit card debt is not. That's going to kind of hover because it takes so long to pay that off. After 5 years, you're still going to owe $346,753. Over here, because we are at $448, after 5 years, we're going to owe $358,445. That's with the $788 going into it. So you're going to be behind the eight ball about $11,000 after 5 years. But years after 10, you are $54,000 ahead of the game. And at 16 years and 11 months, you are $211,000 because you still owe it here, but you don't owe it here. So your net gain is $382,704. So that is the debt management and why it works so well, because you are not actually, if you're hanging on to your 3% or 4% mortgage while you are still paying credit card debt, you have a higher interest rate. So again, all it takes is give me a call. We'll punch your numbers in, see if it works. If it works, great. If it doesn't, that's fine too. Then you know you're on the right path. Again, this knowledge will give you the faith to know what to do. And that's the big thing. Knowledge gives you faith. If you have any questions, give me a holler and we'll talk to you soon.